Hi, everyone. My name is Holly Hughes, and I'm the Chief Marketing Officer at BAI. Thank you for joining us for today's webinar sponsored by Alkami, Accelerate Adoption, Decrease Abandonment, Transforming Your FI from a House to a Home. Before we get started, I want to take a moment to review a couple housekeeping items. If you have any difficulties on your end, please know that a recording of today's webinar will be sent out to view on demand. And if any disruption happens on our end, we'll work to resolve it as quickly as possible. We'll conclude this webinar with a question and answer period. So at any time during the discussion, go ahead and type your questions in the Q&A box that you see there on the right of your screen. Also, at the end of today's webinar, you'll see an online evaluation on your screen. Your feedback is really important to BAI as we strive to address the key issues impacting the industry, especially in today's dynamic business environment. So we do ask that you take a couple minutes at the end to complete that survey. Let's jump into our topic today. In order to transform your FI from a mere house into a welcoming home, you need to bring the right people in the door and accelerate adoption of the appropriate products and services with a strong customer experience throughout the process. Today, I have the pleasure of speaking with two thought leaders who will share key strategies on accelerating new account holder acquisition and product adoption and discuss why continued engagement will lower account holder attrition. BAI Alkami is Vice President, Product Management of Digital Account Opening and Loan Origination at Alkami. He has over 14 years of lending and fintech experience. Previously, BAI was the co-founder and CEO of MK Decision before its acquisition by Alkami in September of 2021. And Jeff Bucher is Senior Product Strategy Manager at Alkami. He brings over 20 years of diverse experience in the financial services industry. His expansive career spans roles in consumer retail banking, treasury management, sales, and product management. Welcome, Jeff and BAI. It's so great to have both of you with me today. So I thought to help set the stage, it would be good to share some BAI research that we've done in this area of account acquisition with a focus on digital account opening. BAI surveyed 2,000 consumers earlier this year as part of our BAI Banking Outlook research program, and I wanted to share a couple points from that research. Over the last year, 21% of consumers opened a deposit account online. In that same period, 11% started a deposit online, but finished opening the account in the branch or over the phone. And Gen Z has the highest new deposit account online opening over the last year at 33%. And on average, Gen Z needed 15 minutes to complete the online deposit application and open the deposit account online. So some research to ground our conversation today, and with that, I thought a good place to start would be a question for both of you. As you think about digital account opening, what are some of the top challenges or threats that financial institutions are facing today?
Yeah, if you mind if I play lead off here, buddy?
That would be great.
Yeah, so we've been receiving a lot of research recently from the financial brand, from Cornerstone. We're seeing a rapid acceleration in checking accounts towards the neobanks, the fintech challenger banks. I think 47% of the recent accounts have gone to the neobanks. If you look at the mega banks plus the regional banks, 85% of all new checking accounts are in those three categories, Holly. Ultimately, we're still seeing the community bank and the credit union kind of maintaining at a 6% per community bank and credit union. The growth trajectory in credit union and community banks has not been as aggressive as we'd like to see. So we still think the existential threat is the neobank, the Chimes, the PayPals with Venmo, et cetera. But there's a lot of new treasury notes that are available for consumption in the marketplace as well. So that's going to be hitting the credit unions and the community banks in terms of challenging their CD rates for the highest yields. And I expect to see a lot of outflows from the traditional financial institution into this new batch of T-notes.
And Jeff, what would you add? What are you seeing?
Yeah, to add and to further this the theme that BAI was talking about, there are a lot of apps out there with regard, so my area of expertise is in payments. There are payment apps all over the place, and even offerings through retail like Starbucks, for example, are keeping balances. And that's taking balances away from financial institutions. So being able to combat that, you need to have multi-factor options for payments, for capabilities for storing balances, for increasing rates, for lending. And I think it's really important to have a breadth of products as a financial institution these days.
So, you mentioned a number of challenges. Jeff, question for you. What are some best practices that financial institutions should consider related to acquiring and retaining account holders?
Yeah, good question. And FI needs to build a strong brand, I think, and get noticed with the digital natives, especially with Gen Z. Make sure digital natives know who you are via online advertising and word of mouth. It's important for FIs to meet the digital users where they are, which is on social media. Make onboarding a fast and positive experience. I think that's really important. Build customer engagement through product adoption and stickiness. I always think of Bill Pay and Zelle as really good examples of sticky products. Build trust with your account holders. Make them feel that their money is safe and in good hands. Protect the account holders' transactions by offering solid fraud detection products. That's come up over and over again with a lot of our financial institutions that we work with. And then constantly maintain communication with your account holders. Gather feedback. Feedback groups are always a good solution. And educating the customers and the members out there by sending newsletters and sharing best practices. Also, offer unique services. So stand out from the crowd by offering products like faster payments, international payments, and buy now, pay later related solutions.
And we know that, friction is certainly the enemy of the digital account opening process, but, some of it is necessary. From our own BAI research, we learned that of those who started online but did not finish opening online, the top reasons were challenges with identity verification, too many questions, and technical issues. Going back to you, a question, what can be done to remove friction from the process to create a best-in-class experience from beginning to end?
Sometimes this takes me back to being a kid at children's camp and playing a game of 21 questions. Some of these application experiences remind me of being back at kids camp with how many questions we're putting in front of an applicant. In a recent webinar, we kind of likened this to going up to a hotel and seeing two armed guards right at the entry. It's not the kind of hotel that you feel welcome to, and it's not the concierge you would be to see. So we're really meeting a lot of our customers, members, almost as if they are assumed to be fraudsters. And it can be a turnoff when your first impression coming to a new financial institution is that you're not trusted, you're assumed to be a bad actor. So I think this is an approach that we have to really change, is how do we invite, kind of in that principle of, if 80% are good actors, how do we ensure that we're treating the majority of folks with a best-of-breed experience? We've gone away from driver's license scans and knowledge-based authentication questions. We find that, 1 in 2 folks are dropping off as soon as you ask for an ID. So we've moved completely to non-documentary identification using back office database checks, whether that's Patriot Act, Office of Foreign Asset Control, et cetera, really to use data behind the scenes to verify identities in lieu of documentary means. But it goes beyond that, as Jeff mentioned, meeting the consumer where they are from a funding perspective as well. We liken the request for them to manually enter routing and account number. It's kind of like a driver's license. You almost have to run out of the room to go find a check. I recently moved and I don't have any checks, so I had to fly all the way across the country to get a check. It's kind of crazy. A lot of people don't know where their routing and account number is in a seamless fashion. So using the Yodleys and the Plaids of the world to link bank accounts through username and password, hard funding, something that's easily accessible. So we look at friction across the entire life cycle of the account opening experience. We definitely see a big pain point in documentary means of identification, and a lot of the newer fintech players are migrating towards non-documentary.
And, you mentioned the lengthy application process, and I think that's something everyone can relate to, both personally and then on the business side, a key part of the friction. What happens, can you talk a little bit more about what happens when that process takes too long?
Yeah, so, the table stakes expectation is how is this going to take less than 3 minutes in today's age? We kind of see it like a race to the bottom in a sense. From experience, comparing the different products to completing an application, again, including the shopping experience, we're seeing about 3 minutes and 40 seconds per user going through the application process. But once that process takes over 5 minutes, we're seeing up to 60% drop-off industry-wide. So once the time doubles in terms of how long the application takes, the drop-off shoots through the roof. And it just comes down to the attention span of the next generations. They're getting hit with notifications from all kinds of applications, most of which we know are spam. But the attention span is very quick in this modern generation. So we've designed our application experiences to be more bite-sized pieces and give that immediate gratification screen by screen.
Very good. We know some abandonment is going to happen. You can't, get rid of it entirely, regardless of how well the process is optimized. One of the findings from the recent BAI Banking Outlook research was that 4% started a deposit account online but never opened that account. So Harai, I would love to, ask another question for you. How should FIs address this challenge more specifically?
Yeah, so omnichannel is a buzzword in our space, but what does it really mean? We see three primary use cases. Holly, it's somebody who starts online and completes the process straight through. Someone who starts online, abandons that application, receives email or text notifications to resume that application, avoiding an abandoned app altogether. And then the third is somebody who starts online and wants to finish in branch. So as long as you're able to address those three use cases, we'd strongly suggest folks build campaigns around following up with those abandoned applicants, either via phone or email, depending on what data you have. But ultimately, the true omnichannel experience requires those three use cases.
Jeff, back to you, a question for you. Let's talk about this broader engagement within the channel. What steps can FIs take to create engaged digital banking users?
Yeah, I think a lot of it has to do with the user interface. The user interface makes a very deep first impression. An old UI can turn users away before they can even get engaged. And you want them to have that experience from the beginning because they're going to be looking for it. I've seen that ease of use and functionality are absolutely key. Things like fewer clicks to navigate to important pages, speed and responsiveness are important because digital users typically have absolutely no patience and they want what they want right away. That's kind of the standard. The digital experience should be quick and responsive, and mobile-first approach is absolutely critical. Personalization is also something that I think is really, really important for digital users. Users like to be able to create their own landing page. They'd like you to allow, they'd like to see their financial education and financial score insights on pages. They want to educate themselves. And then, offering multiple touch points for users to connect to you with service and questions. Having the chat box to be able to ask questions. Some people don't want to pick up the phone. They just want to be able to get an answer right away, right in front of them. So offering that, I think, is critical. And then something that is simple but can be impactful is to use an account holder's name throughout the digital experience. So, from the time they sign on saying, hi, Jeff, how are you? And then, walking through and then in the service, using their name. I think that does leave an impression with users.
And Harai, I know you work with a lot of different FIs. What have you discovered about the institutions that do digital account opening really well?
Yeah, Holly, I think there's a agile versus waterfall approach to software development that is still kind of different financial institution by financial institution and how they approach deploying new software. When we think about agile, it's kind of getting to that minimum viable product to go to market and then iterating from there. Because even if you don't have every single piece of functionality that you may have had in the past, that doesn't mean that you won't perform at a higher level. And so that's one of the things that we try to communicate to the industry is it's not about having every feature in digital account opening. It's about the choice architecture and the design of the onboarding and decisioning flow to optimize for efficiency and conversion. So we see folks that take an agile approach. They love to study their metrics around drop-off rates, conversion rates, time spent in application. They're looking deep at the decisioning criteria and really trying to study fraud patterns and look for ways to work with the fraud vendors to optimize for new types of fraud or themes that they're seeing within fraud. So I think that number one would be just taking an agile approach, consumer and member experience driven, optimizing for that onboarding journey and really focusing on what the consumer is expecting now that they've been accustomed to e-commerce the last 3 years, whether it's ordering groceries, books, toilet paper, who knows. We've all been ordering through e-commerce nowadays. So there's newer and a broader exposure to e-commerce nowadays. So how does the account opening experience mirror an e-commerce store is something very popular in today's age. And then I think folks who are ultimately looking at this as a long-term process, I think if you look at a vendor that's been around for 30 years, you might get a product that they said it and they forget it. But if you're working with a vendor who's really coming in and saying, we're trying to compete with the neobanks on experience, the Apple and Google's on experience, then it's really a journey that you have to look forward the next 7 to 10 years in terms of optimization.
And another finding from the BAI Banking Outlook research was that of the most recent new loans opened online, 75% were opened at direct banks, organizations with no physical branches. Harai, you mentioned neobanks earlier. Jeff, with stiff competition from digital players, what's the best pathway for banks and credit unions to create stickiness with account holders and achieve that primary FI status?
Yeah, the market has changed. We used to define the primary financial institution by whatever institution had the checking account for the account holder. That's not the case anymore. Today, just 14% of consumers consider their primary financial institution as their only FI. So consumers now have multiple accounts across tons of different apps, as well as other financial institutions. This can sound actually contradictory, but it's important financial institutions can move money to other financial institutions. So connecting through account-to-account transfers is really critical. 8A has really taken off because this is becoming more of a norm, kind of the open banking model, so to speak. And the volume of same-day, for example, the volume of same-day ACH has reached over 385 million in terms of volume for the first half of 2023, an increase of like 13%, I think it is. And then RTP and FedNow are also contributing to the 8A transfers. Now RTP has been out since 2017. It's up to about 65% of the account or households out there in the U.S. are now linked to that rail. FedNow just came out. FedNow is doing a ton of marketing and really trying to get involved, and they're reaching out specifically around 8A to try to connect different banks together, through this use case in particular. Also, I would say ensuring account holders have multiple products and services is also important for keeping that engagement. You want to have probably at least 3 different products, and if you have the metrics, if you have the data, you can identify this. That's important for each of the users and the account holders. Again, personalization is key as well. Users now expect personalization due to their experience with the smartphones that they use. So, you can personalize the page, you can personalize, how you look at it, you can personalize all the apps, everything. That's become, kind of the expectation as well. And you could also examine account holders' data. So I mentioned data before. Data can be really critical. Having the intelligence, the data intelligence to research what products and offers would fit with account holders can really tie them in. It can get up to that 3 products and services that you would want. And then if you track and learn and adjust using marketing automation tools, that can really tie them in and give them that engagement that you're looking for.
Let's explore some revenue opportunities in more detail. I think we've covered a lot of interesting areas. It would be great to talk about revenue. Question for both of you: how can digital account opening help FIs generate new revenue opportunities? Harai, I'll start with you, and then would love to get your thoughts, Jeff, as well.
Yeah, so just coming back to that first impression when opening an account, if a consumer has a delightful, memorable experience, are they going to be more or less likely to use the debit card that accompanies that newly opened checking account? So I think if you start with that question, the obvious answer to me at least is that if they enjoyed opening the account, they're more likely to use the debit card. They have a good experience with your institution. That's going to obviously drive your interchange revenue. We look at interchange revenue as the key from a top of wallet experience. From there, we're working with several providers, both Truth and Atomic, and the direct deposit switch space, ultimately focused on helping the newly created account get updated with the payroll provider as the direct deposit account. So once you've won that direct deposit relationship and now you know that their employer is going to be depositing the funds in this new account, we would say that you have preferred financial institution status. At that point, you have a long-term relationship that it comes down to how am I going to nurture it? How am I going to take them from a single checking account product and cross-sell into either CDs, money markets, and then onto the lending side with cards, unsecured loans, et cetera. So we really think the first impression is the last impression, and folks who enjoy that onboarding and first account opening experience are more likely to adopt more products in the future.
And Jeff, what would you add?
Yeah, I would totally agree with Arai. I think he's touching on a point. The implementation, the onboarding, really sets the tone for how you're going to have an interaction with this user, with this account holder, going forward. You mentioned the interchange. I would also, highlight cross-sell into products where there's fee revenue potentially. And this can vary between credit unions and banks and how sensitive the account holders are with regard to fees. But sometimes, I mentioned AAA before, you can charge, small fees for these transactions. And if there's value added there, you can charge those fees, and that can be a form of revenue that, is not going to hurt your balance sheet either, in terms of the fee revenue. So that's definitely something to look at. But, it starts with the first touch with the client and setting the tone and trying to cross-sell into different products. But you've got to add value. It can't just be, here's a savings account, no reason, let's just give it to you. They want to see, something of value. They want to see something that's going to help them.
And Jeff, you mentioned data earlier. I want to talk a little bit more about that. There's certainly a wealth of data that leaders can access around digital behaviors, including data that could suggest a retention risk. Jeff, another question for you. What are some leading indicators that suggest a new account holder would be likely to attrite that FIs should be looking out for?
Yeah, it does come down to data. You have to see what's going on with your members and your clients. You need to see how many accounts they have, how many products they have. So I mentioned the 3-product bar there as kind of at least a minimum to look at. I think that's critical. If you have the data on balances, seeing a drop in balances would be key. One of the financial institutions I used to work at kept track of this on a day-to-day basis, and we would look for large drops in balances. If you see that, that's obviously an indicator that somebody might have tried. A reduction in transactions, so if they are doing a lot of transactions and all of a sudden that goes away, that could be an indicator. And then also seeing a reduction in sign-ons. So, we provide our clients with, digital platform information in terms of number of sign-ons, and that could be a great indicator. Data reporting is definitely important in order to wrap your arms around these, if a client is going to try, if you've got a good relationship with them and if they're going to stick around.
And in doing this important work, FIs definitely need to have solid partners. Hadai, I would love to know, what do FIs need to consider when evaluating a digital account opening vendor?
It comes down, Holly, to what's important to the financial institution from a cultural, results or outcomes-driven kind of KPIs or objectives and key results of the institution. Ultimately, from the culture, is this company that I'm partnering with and the product that they're building in alignment with my mission and the way that I want to treat my customers? I think that's very important because if you find yourself partnering with somebody whose product is 15, 20 years old and they have no future proof for that product, it's literally what it's going to be 15 years ago, the next 15 years, you have to ask yourself, am I okay doing what they've done for the last 15 years for the next 15 years? So those are some tough questions. The partnership is going to be important because every implementation has its ups and downs. These are not simple implementations when you're integrating identity and funding and credit and cores and digital banking. You're doing nacho file processing. There's a lot of moving parts in one of these implementations. So I think the relationship is very important. Are these the kind of people that I want to know, that I want to work with, that I want to have in my professional network, that I believe if I pick up the phone and call them, they're going to be on the other line to help me when I need that help. And then from there, it comes down to product vision. Is this company in a product vision mindset, or are they trying to optimize for revenue. You kind of have to find that vendor. Sometimes vendors get sucked into private equity deals, and all the talent leaves the organization and goes on to startups. And so now you're dealing with a lack of subject matter expertise on that product. So sometimes you could be working with support folks that don't even know how to support the product. So these are all important questions. I would definitely encourage financial institutions to ask their vendor partners, why did you select this identity verification partner? Why did you choose to fund with these methods? Get into the psychology of how they designed their flow, and then ultimately ask them, what are the key performance indicators that you all are measuring yourself to demonstrate positive business outcomes to me? Because I think at the end of the day, if you have aligned business outcomes with your vendor partner, then you guys will know in your quarterly business reviews whether you're moving in the right direction as a partnership.
That's great. I think some really helpful points for people to consider. A question has come in the Q&A that I'll weave in right now around account funding. So anything that you would share, we've talked about acquisition from a lot of different angles, but more specifically to, getting that funded account, any suggestions you would offer there?
Yeah, I'll jump in on this one. So right now we're using Yodlee for instant account verification. So user enters their username and password and then sees a list of the accounts within their bank account to select one as a funding method. So that's a very nice modern form of funding. We then pull the routing and account number through Yodlee's integration to the bank account, and then we're actually able to generate a notcha file. So that's an ACH means of funding. We also offer debit and credit card funding through our partner Alacrity that Jeff works very closely with on the loan payment side and other areas. But giving them the debit and the credit card option for funding is very important. And some of our financial institutions offer different funding limits depending on the method that's selected. And then one that I think is often undervalued, but to me is an unsung hero, is if you are open to opening $0 accounts on the core, with Alkami Digital Banking, you can actually query those $0 accounts on the core and have sequential email campaigns driving that consumer to fund within online banking itself. So similar to the Chime experience, where they actually don't ask you to fund when opening the account, only until you've downloaded the mobile app and logged in are you prompted to kind of link your external account and then fund. Here at Alkami, we think that's a great fail-safe fallback method for funding. And we have one kind of all-digital bank that found 7 out of 10 folks are funding that way within online banking. So those are 3 primary means of funding.
Great, thank you. And, we just have a couple minutes left, but before we wrap up the discussion, is there one last piece of advice that you would like to offer FIs that will help them serve all their account holders' needs today and into the future? Harai, I'll start with you and then give Jeff the last word.
Yeah, I would just say don't be afraid of change. Meet your customers where they are. Pull the ideal customer profile aside. So you have 5 customers that are in the right demographic, they have the right kind of income, they have the right kind of payment history with your financial institution. Pull them aside. We do this all the time in our product teams, right, Jeff? And do some surveys with them. Ask them, what are the things that are important to them? What are their needs that either we are or are not meeting? And ultimately treat your customer base in a very loyal, matter-of-fact way so that you can think more like your customer and sometimes less like yourself. We definitely want to put our customers first. And here at Alkami, that's the way we design our products, is with the end consumer in mind and then our financial institution partners in the middle. But I would just say do some user surveys and pull those customers aside and ask them the questions on how we can do better.
And Jeff, what would you add?
Yeah, I same thought actually. I think understanding your account holders' needs is critical. You can use data. You need to have feedback groups. You need to be able to understand what they are looking for, and then you need to be able to take it down to the micro level to each of the account users as best you can. The bar has been set really, really high for digital experience. And financial institutions haven't been known for being the most out front in terms of the digital experience. But, I think that bar extends because I think customers, members, account users just really have high expectations these days, and everything you can do, to get them from the beginning all the way through the end of the experience and hold on to them is absolutely critical.
Well, Jeff Rice, thank you so much for all the valuable insights that you shared. We'll go ahead and pull in that survey. And again, we'd love it if you could take just a few minutes, all those who are listening in today, to complete that survey, give us some feedback so we can continue to bring you really great content. As a follow-up to today's session, you'll receive an email from BAI within 24 hours that will include a link to the webinar. We encourage you to share that link with your team or other peers who you think would benefit from the insights that we share today. And you can learn more about BAI and find other relevant content, actionable insights at our website, which is bai.org. This concludes our session for today. Thanks again, and have a great rest of your day.
Take care, everyone.
Thank you.